is looking at the Bank of Canada, interest rates, and what that all means for the housing market here in Canada. I know that's on a lot of people's minds.
It definitely is.
So for this session, let's really dig in. The mission is, well, pretty clear. Why is the bank cutting rates? And what are the ripples, for real estate? We'll stick to what's in this piece.
Sounds good. And the timing on that article is key, right? It came out April 12th, 2025.
Yeah, just before the bank's next announcement. That's Wednesday, April 16th.
Exactly. So it gives us this snapshot of expectations right before the decision, what people were thinking, how the market felt.
Okay, let's get into it. The article points out the banks already cut rates twice recently. Quarter point each time.
0.25%.
And the last one was March 12th. That brought the rate down to, what, 2.75%?
That's right, 2.75.
But back then, wasn't the economy actually doing... Okay. Like the article mentions solid GDP, inflation heading towards that 2% target.
Yeah, that's a really crucial piece. At that moment, in March, the core Canadian economic numbers looked pretty decent.
The bank even said so, right? Called it a solid position.
They did. So the cut wasn't really about fixing an immediate problem within Canada necessarily.
Okay, so here's the twist then. The March cut happened like a week after the U.S. hit us with those big tariffs, 25% under President Trump.
Right, and then Canada retaliated, of course.
And the article really stresses this point. The bank specifically mentioned these trade issues as a big reason for cutting.
They were looking ahead.
They figured it would slow down the economy, but also, and this is the weird part, push inflation up.
Exactly. It seems a bit counterintuitive, but tariffs, they disrupt things. They make imported goods more expensive.
So more expensive stuff means higher inflation, even if the economy's slowing down overall.
That's the risk they saw. This big external shock, the trade war stuff, it created this significant risk, even with the domestic picture looking all right.
So the bank was trying to be proactive, get out in front of it.
I think that's how the analysis reads it, yeah. That concern about inflation, specifically inflation caused by the tariffs, was a major factor in lowering the rate back in March. Trying to cushion the blow, maybe?
Okay, so that brings us to now, or, well, this coming Wednesday, April 16th. The bank's making another announcement.
And this one's bigger, right? Not just the rate.
Yeah, the article says it includes the full monetary policy report, like the detailed breakdown.
Their whole assessment, their outlook, commentary. The works.
And the expectation. The article quotes Penelope Graham. She's a mortgage expert.
From ratehub.ca, yeah.
She thinks another cut is coming. Quarter point again.
That seems to be the consensus view presented, yeah.
Why, though? What's the reasoning now?
Well, Graham points to a few things. First, remember that 90-day tariff hold President Trump announced?
Yeah, markets like that for a minute.
Right, but Canada wasn't included. We didn't get that pause.
Ah, okay. That's important.
Very important.
Yeah.
So as Graham puts it, the reality of permanent economic damage is setting in for Canada specifically.
Yeah. So the bank is looking at the damage to our trade partners, the effect here.
And it's not just trade figures. She also mentions plummeting consumer and business sentiment.
People are getting nervous. Businesses, too.
Exactly. The bank's own surveys apparently showed that confidence dropped quite a bit.
And when confidence drops, spending slows down, investment slows down.
Right. It can become a self-fulfilling thing. So the idea behind another rate cut would be to try and offer some support.
Help Canadians shore up, I think, was the phrase used.
Yeah, amid this really uncertain, kind of unprecedented economic backdrop, using the tools they have.
The article also talks about bond yields going kind of wild, market volatility.
Yeah, that's directly tied to mortgage rates, especially fixed rates.
Graham noted the Government of Canada 5-year yield. That's the key one, right?
It's the benchmark, yeah. Lenders look at that for setting fixed mortgage rates.
It apparently dipped really low, like a 3-year low, around 2.4%.
Briefly, yeah. But then it jumped back up pretty fast.
Why the reversal?
Well, the article mentions spooked investors selling things off. It just reflects that huge uncertainty.
So yields dipped when people got scared and wanted safe assets like government bonds.
Which pushes yields down, yeah.
But then the uncertainty got maybe too uncertain and they sold off again.
Something like that. It shows there's no clear consensus on where things are headed.
Yeah.
And now yields are higher, sort of upper 2.7% range.
Which means upward pressure on fixed mortgage rates.
Potentially, yeah. Even if the bank cuts its main rate, fixed rates could still nudge up because of what's happening in the bond market.
Wow, okay. So much uncertainty. And it sounds like home buyers are feeling it too. The article mentions Toronto sales data.
Yeah, double-digit drops in sales, percentage-wise.
That's significant. People are definitely hitting pause.
It points to a lot of caution. Making a huge purchase like a home feels risky when the economy's shaky and rates might go up.
But, okay, maybe a little bit of hope. Graham suggests that Trump tariff rollback, even though it didn't include us.
Right, the 90-day one for others.
It might still help stabilize things generally. How does that work?
The idea, I think, is that if global trade tensions ease off even a little bit, even temporarily.
Even if we're still facing tariffs.
Yeah, it might just calm the overall market jitters. Less panic globally could mean more stable financial markets, maybe stop mortgage rates from spiking further.
And that, combined with another Bank of Canada cut,
could maybe create a bit more predictability. Perhaps tempt some buyers back if they feel things aren't spiraling.
So a potential pickup in activity, but it really depends.
Absolutely depends on how the trade stuff actually plays out and how the Canadian economy itself holds up under the pressure.
It's all connected, isn't it?
Very much so. The article really highlights how interconnected things are. Global factors, domestic policy, market sentiment.
Okay, let's make this concrete. The article gives an example of what another cut means for someone with a variable mortgage. That's useful.
Yeah, it helps see the direct impact.
They use the average Canadian home price from February 2025, around $668,000.
$668,097, yeah. And assumes a 10% down payment.
So mortgage around $620K. Current variable rate in the example is 3.95%.
Right, standard 25-year amortization.
Monthly payment comes out to $3,244.
Okay, now add the potential 0.25% cut.
New variable rate, 3.70%.
And the new payment
drops to $3,161.
So what's the difference?
$83 a month.
Right, $83 less per month.
Which adds up. Over a year, that's nearly $1,000.
Exactly. For people on variable rates, these cuts mean immediate savings, some breathing room in the budget.
It's tangible relief, though, of course, variable rates can also go up.
That's the trade-off, absolutely. There's always that uncertainty with variable.
Good point. Lastly, the article lists the upcoming Bank of Canada dates for the rest of 2025.
Yeah, handy to know when to expect updates.
Looks like June, July, September, October, December.
And remember, some of those include the full report, like the upcoming April one.
Right. April, July, and October have the detailed monetary policy report and commentary. The others are just rate updates.
So those report dates are the ones where we'll get the deepest insight into the bank's thinking.
Definitely worth keeping an eye on those dates, then, to see how things evolve.
For sure.
Yeah.
It tells us how they're reading the situation as it changes.
Okay, so wrapping this up. It really seems like these rate cuts, the ones that happened and the one that might be coming, are basically the bank's response to all this economic uncertainty.
Mostly driven by the U.S. tariffs, yeah, and the resulting drop in confidence here.
And while the cuts give some relief, especially to variable mortgage holders,
and might help stabilize the housing market if buyers get less nervous.
The bigger picture, the overall outcome, it really hinges on stuff outside our control, doesn't it? Like the trade situation.
And just the general health of the Canadian economy trying to navigate all this. There's a definite balancing act for the bank.
The analysis we looked at really drives home how complex it is, how linked everything is.
It really does. Domestic policy responding to global shocks.
So thinking about everything we've just discussed, the trade stuff, confidence, market swings, what do you think is the single biggest cloud hanging over the Canadian housing market right now? Is it the trade war? Is it fear among consumers? Maybe something else. Definitely something to mull over as we see what happens next.